So in terms of TEAMFund, and thanks everyone for joining and for the nice introduction. TEAMFund was started back in 2015, and originally the idea was born from two co-founders, husband and wife. They both spent a good portion of their career in healthcare. Tim Ring, who was on the industry side in different multinationals, he was a CEO of CR Bard. And then his wife, Catherine Gleason, was an attorney, led a large life science practice at Morgan Lewis. They sort of asked themselves this question as they got to a phase in life where they had done a lot of things professionally and wanted to think about kind of giving back. And they said, all these healthcare innovations that we're involved with, whether they're big companies or startups, et cetera, most of them are really oriented towards, a very small segment of the world's population. Okay. Um, and, what is it that we would need to do to make it accessible to the other 5 billion people in the world that don't always have access to leading medical technologies and innovations? And so when TEAMFund started, our definition of underserved wasn't sort of the bottom of the pyramid. Okay. It was a much larger segment of the population that just don't have access or can afford the types of things that we often take for granted. And so from that, they went on this what they call a listening tour, and they went and visited a whole bunch of folks, academics. They visited global health innovators. Folks like Krista were part of that original listening tour, and so they were really learning a lot about what the challenges were in terms of how come these gaps still exist. And really, two things emerged. One was funding. Okay, a lot of innovations just don't have access to capital. And number two is expertise. So if you have these innovations, you need people and sort of an ecosystem to help them flourish. Embedded in that, there's sort of a third assumption, though, right? Which is that you can't just easily transplant things in a developed market and kind of donate them to the emerging market or to the underserved, right? I think there's been this long-standing uh, 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 kind of push for companies in the U.S., for instance, that have technologies that are maybe outdated or they no longer need. They've gone through their useful life. They can donate those to the third world, and at least they can make use of it. But that really doesn't work, and they end up kind of just going into big garbage piles of things because you need parts and you need people that know how to service them and so on. And so really what you need are ideas that are born from local markets that can be used in local markets, but that are engineered for the challenges of those specific areas. Okay. So I think, having kind of a local grassroots approach was very important to us at TEAMFund. So when we launched, we decided that we wanted both a nonprofit and a venture fund. A nonprofit so that we could build relationships with multinationals, build relationships with NGOs and multilateral, government organizations, just any group that can help and that's interested in global health initiatives. And then the venture fund so that we can identify companies, invest in them, and support them. So even today at TEAMFund, and we're in the process of launching our second fund, the nonprofit is just as integral and important and as active as the venture fund is. I was brought on board to lead the venture fund activities. My background, as Cyan mentioned, was more traditional finance and venture capital. So really, this was my first foray into global health was through this fund. And so what we do now, we launched our first fund in 2018, and so fast forward to today, we have 7 portfolio companies. We're agnostic as to where those companies are. We have one in Boston, we have one in Seattle, we have a couple in Bangalore, we've got one in Delhi. They're all over the world. So long as they have a technology that's addressing an underserved population. And our definition of underserved, it sort of changes based very much on the geography and the nature of the disease that you're talking about. Okay. So there's not a one size fits all approach to the way that we think about how we define underserved and how we define impact. And this will be important because you will encounter a lot of impact investors, and everybody's got a different definition and they care about things a little differently. Um, and so we were very much focused on India and sub-Saharan Africa. So we have a company, I'll give you an example, EcoNews. They're based in Seattle. They were started by former Sonosite guys. They were originally funded by KKR. Okay. That may not feel like what is right down the fairway of an impact investment. But we liked it because point of care ultrasound is really important as a tool for diagnosing patients, with a low cost mechanism. It's non-invasive. You can easily train people to use it. So the task shifting component is also quite attractive to us. The cost and accessibility attributes of POCUS are also quite interesting. So when we looked at the landscape of different players, we identified EcoNews as the one that we liked the most. And there were other players at the time like Butterfly. Many of you might have heard of them. And they were pretty big, kind of going all over the place in the global health space as well. But they were too expensive for us. At the time that we looked at them, they were valued at close to $2 billion. And two, we didn't believe that their technology was the right technology for emerging markets, okay, or LMICs. And so when we look at a company like EcoNews, we say, all right, this is a U.S. based company with the U.S. founding team. KKR is their venture backers, but we can plug in and really help them link to emerging markets, identify the opportunities, identify the spaces where they think they can have value, and also create links through our partnerships. So we've got partnerships with other multinationals and pharma companies. And so I'll give you an example with EcoNews. Merck just got a drug approved for pulmonary arterial hypertension. And one of the ways that you can manage those types of patients is by using point of care ultrasound and having them come in every 6-8 weeks to kind of manage their disease. And so Merck was very interested in a point of care ultrasound technology, and EcoNews had it. And now they've teamed up and they're going to start to launch pilots in the emerging markets. Okay. So long way of sort of describing what we do, but it's important to recognize that it's not just about finding technologies and investing in them. It's also about looking for opportunities and creating the impact that you want. Okay. And so a lot of companies and technologies could be relevant for an impact investor like us. It may not be what the company's looking at today because they're focused on other things or they have other priorities. But if we see that there's an interesting segue, we will try to get involved with that company and create that bridge. Okay. So in other words, we can create the impact even if it's not there on day one. And so in addition to the capital, we do the funding. In addition to the capital, we provide the expertise. We don't always take a board seat because we're kind of a smaller check in the grand scheme of things. We don't match up to KKRs of the world or even close. But we do stay quite involved. So actually with EcoNews, we have a board observer seat, for example. So, we do, irrespective of our check size, stay quite involved with our companies. This is not always true of all impact investors. Okay. I would say we might be on the more unique end of the spectrum in that way, in that we can provide capital and then we can also, leverage our expertise in a lot of ways, operational, strategic. We help with exits. So there's kind of a broad spectrum of things that we can provide. But that's kind of the snapshot of TEAMFund 1. We're just now on the cusp of raising our second fund, which will be significantly larger, 150 million, where we'll invest in similar types of companies. We're also opening our aperture to look at U.S. underserved markets. There are a lot of areas, rural healthcare, prison systems, Native American health services, the VA, There are just a lot of areas within the United States, whether it's urban or rural, where there are opportunities to also have this type of impact. And so in our second fund, we're going to include US as part of our story. So let me kind of stop there, and we can go down a path that's maybe most interesting for you guys to go deeper into.
Yousuf, I will check if there's any questions in a moment, but I just want to give you some framing on what you just said now from this group's perspective, is that we have many of our teams actually looking at underserved populations in the US market. The theme this year is cancer, and so there is fellows working on smaller population groups that haven't actually received a lot of care, specifically in thinking about the post-cancer sequelae. And we just have some groups which have smaller market sizes that perhaps would be well suited to impact investing. So as you maybe dive into thinking about how our group would go about making contact with an impact investor, how to align fund theses and what we're doing, to also just perhaps keep that in mind. But before you dive into perhaps the explanation, but are there any questions on what Yousuf has shared so far? Anastasia?
Yeah, thank you so much for sharing your thesis and your whole story. I mean, similarly to Sayan's point, you mentioned that the startups you're working with maybe already have other funds or have other market focuses, and they are trying to expand like a parallel impact trajectory. So do you think that this is a prerequisite for you, given perhaps maybe the amount of funding you can allocate, that we should be thinking about creating sustainable business-wise companies and then having parallel impact trajectories? Or do you see also like a company that could be completely funded by impact investment mechanisms, and how do you approach that too?
Yeah, that's a really, really good question. So let me maybe answer it from a few different ways. One is, I think it sort of depends on where the company is and kind of what their principal, focus is. So for instance, I'll go back to Echo News. Their principal focus is really not, LMICs and developing markets. Okay. But it's an important segment for them, right? In other words, it's not sort of in the other category, like, oh yeah, hey, that's nice to have. We've got TEAMFund. Let them kind of do that, and we'll just add that in. It's pretty important for them, because specifically for that company, they can fill an unmet need that doesn't really exist with other products in the market. In other words, their portable ultrasound is clinical grade. It's of the same level as a cart-based system. The cart-based systems are like $100,000. Their system is like $4,000 to $6,000. And so now hospitals or facilities and LMICs can actually afford to have a unit, or maybe they have another unit, okay? And the alternative is that they don't have anything. And so for Echo News, it was important that this segment or this opportunity gets defined, the feasibility, the opportunity, the go-to market. How does it get reimbursed? What does the distribution look like? There's a million questions. And so when we step in, we can partner and really help open a door to an important segment. And I think that's critical, right? We don't want to just jump in and be kind of a nice to have, other, page 30 of the slide deck kind of thing. It should be an important part of their strategy, even if it's not central. Now, if I flip to a different situation, let's say a company in Bangalore, we've got one called Forest Health. They designed their products specifically for underserved communities. Okay, that's their fairway. And they do that really, really well in India, and they've got good relationships. And actually, some of their other investors are more valuable than we are in terms of opening doors and facilitating access in India. But now they're trying to figure out, how can we bridge into other markets? Okay, because one of the biggest challenges is that for all these companies, how do they get scale? How do they get to profitability, right? And in places like India, you can pretty quickly plateau. you can get to like 5-10 million in revenues, and then it gets really difficult to kind of step up from there. So so they whether you're in the US or in India, either way, you're talking about kind of a crossing an ocean and becoming a multinational player. Okay. So I think for the question that you asked, I think it's important that, whatever part of the story you fit in, you identify an impact investor that can help you kind of. Oh,
Let's see really quickly, Boris is
did I lose you guys?
We're here.
We can hear you. You're back.
Oh, okay. Sorry. Somebody else was calling me on my on my phone. So and there's different types of impact investors I think that can help, but I do think it's really important for us, and I think for most impact investors, that it's not like, oh, this is just kind of a very nice to have, which, by the way, it could be perceived that way. If you think about, you know pick any country in Africa, right? We talk about Africa as one place, but it's not. It's 50 places, and it's like 10 that a lot of people focus on. And those markets are pretty small. The Bay Area is probably a larger market than most African nations from that perspective. And so the commercial opportunity really has to be kind of developed either by the company or with your impact investors in a way that there's something exciting there. Okay. And by exciting, I mean, government contracts, large tenders, things that could be hundreds of thousands or millions of dollars worth of business potential. Because then it really helps to align the incentive of the impact investor and what the company is trying to achieve, right? Which is revenues and growth and profitability and all of that. And I think if you're operating in an LMIC kind of the old-fashioned way, one doctor office at a time, and that kind of thing, your growth trajectory is going to be so slow, and you might just spend more money than it's worth, that you're sort of setting yourself up for having fatigue, and you might pull out after a while. So I think it's really important that companies, if they're wanting to do things in certain geographies, that they find the places and the opportunities that can be exciting, so that it mirrors with commercial opportunity and just overall business success.
Great. We have another question, Yousuf. Mohit?
Yes, Mohit. I was wondering, how do your companies strike a balance between meeting the requirements of the context in which the ideas originated and then expanding to other geographies?
Yeah. So like most startups, right? Every, I don't know, 6 months or a year, there's kind of a learning curve and an evolution that happens anyway, right? And so I think a couple of things kind of happen in my experience with these companies. Number one is when they hit this plateau. Okay. It's easy to look at, and I'll use again India as a market. 1.5 billion people, and you can do this top-down analysis of the market opportunity in a tier 1, tier 2, tier 3 city, and you can do the math in a lot of ways to make it look like, oh my gosh, this could be huge. But then there are the market realities and the risks of those market realities, and you quickly figure out that it's maybe not that easy. And so then you start to look at sort of contiguous markets, right? Because those could be low-hanging fruit. There could be a distributor that sees, oh my gosh, you've done really, really well there in India. We want to use you now in the Philippines, or we want to shift you over to Malaysia. And there are these sort of nearby markets where those things can start to become useful. And so often we see that it's the founding teams and the commercial leadership that sort of identifies, we really need to expand, to grow. Because I think if we just go in and tell them, hey, you really have to do this, then they say, okay, great. Well, can you give us the money to do it? Okay. And we can give a little bit of money, but our check sizes for an ask like that are going to be $1 million, okay, $2 million. That might be enough just to test the waters in a new market for like a year or two. Okay. We can help bring in some additional capital. But really, it's much better if the founders or the CEO and the leadership kind of identifies this. They bring it to the board. It becomes a priority, at kind of the board level with the other investors. And then everybody's kind of bought into, all right, now let's think about a new market. Let's expand and grow the business in that way. This may shift a little bit with us in our next fund because we'll take bigger positions. And so we'll have a bigger seat at the table. So we might be able to be more influential with our companies to say, hey, look, stop this, start doing that. But right now, that's not the case. I think it's best if the company kind of leads it.
Yousuf, we have got some more questions rolling in. I know we have one online and one from Nathaniel in the back there. But before we take any more questions, I want to come back to you and just give you a chance as well. I know one of the things you'd prepared was just to maybe give a brief overview of the impact investing industry, like how would this group of fellows and anyone joining online, how would they think about getting involved with funding from an impact investor? There's obviously a large spectrum of impact investors. And are there any practical tips and key differences we should know about when getting funding from, an impact VC compared to a traditional VC?
Yeah. So let me maybe start first with my view of the different types of impact investors. So one type is like TEAMFund, okay, where I would put us kind of under the umbrella of more of a traditional VC. All right. So the way I would evaluate a company is going to be very similar to what a traditional VC would do in terms of looking at IP and team and market opportunity and syndicate of other investors. The investment that I make is going to look just like the investments that other VCs are making. Okay, so we're kind of putting in market level terms as well. Now, because we are investors that are focused on impact, this is the wrong word, but I'll use it. We have, I think, more of a conscience towards founders, right? So we're not going to look at an opportunity to kind of squeeze them out or to kind of take advantage of the situation, okay? And a lot of VC investors are very opportunistic in that way, right? Hey, you didn't close your round of financing. We're going to put these onerous terms on you. We'll give you the capital. But so we don't do that. But if you pulled up one of our term sheets or investments, it's going to look like an investment from any other venture fund. Okay, we've got liquidation preference, and we sit at the same series of investment as other investors. And so what that also means is we're expecting market level rates of return also. Okay, so we're looking to figure out how do we manage our investment such that we can get our money out plus our returns. Our LPs are expecting returns. Okay, so we have a hurdle rate, we've got return profiles, we've got carried interest, so we're set up very much like a traditional venture fund. And there are other groups like us. And the other thing that we care about, obviously, is impact. And I think that manifests kind of in three different ways. One is when we're doing our due diligence, there's an extra category of due diligence that we do that is specifically related to the impact. Okay. And what we care about may not be what other impact investors care about, by the way. Okay. There are groups that focus on other types of demographics. And it could be related to gender or race or age or certain segments of the population. We just look generally at underserved markets and underserved populations. So we have a much more general view of what that can be. But when we do our impact analysis, we will look at the demographics too. Hey, are you affecting, women and children, more, the elderly? Are there any, disadvantaged segments of the population? Maybe it's rural healthcare or something like that, because we want to be able to highlight those things. Okay. And so that's one way, right? Is in the due diligence process, we will do impact due diligence, which means that's more work for you as an entrepreneur because you have to supply these types of information to us. And if you don't have it, that makes it very hard for us to kind of, validate what it is that you're saying is true. And sometimes there's a mismatch between what we can get and what our expectations are, right? In a digital era where people are using, tools that leverage technology and internet and, technology infrastructure, there's somewhat of an expectation that you're getting data, right? So if I ask a question like, oh, okay, well, what percent of the, 200,000 patients that you've done today were on, different age groups, men versus women? Can you tell me by zip code? Can you map those zip codes to, population density or socioeconomics? Okay. You would think that those should be pretty easy things, but they're not. And so, but as an impact investor, or if you're seeking impact investment dollars, having data to, substantiate or support, the impact that your company could be having is going to be very important. Because you need it on the front end. And then after we make an investment, we continue to monitor and track that. And actually we synthesize and we put it in a report every year. Okay. Now, everybody has a different version of how they do that. Not everybody publishes their report like we do. If you go to our website, each of our companies has got like a 50-page report. I've actually never seen any other impact investor have anything quite that detailed. But the company can use it for their own marketing. They can maybe use it to get non-dilutive capital. They can use it to get project finance. So there are a lot of things that the company can use with that. But we're probably on the extreme edge of the spectrum of gathering information, synthesizing it, and then reporting on it. But some level of reporting is going to be required by all impact investors. And so so that's kind of the last way in which we use that impact information. Now, because we are a venture investor, our touch points are going to be pretty frequent, right? It's not just quarterly at the board meeting. Like, I'm talking to my CEOs probably once a week, if not once every 2 weeks. Okay. At the most, 2 weeks goes by. So we have high touch points, and it's not always, hey, what's the latest impact number? It's, hey, what happened with that one supplier? Hey, did that one contract come through? We're just trying to be helpful on all fronts, whether it's impact related or not. We want a successful company. Then there's another type of impact investor. Okay. And that could be, foundations, they could be corporates, right? And they have a very specific objective in mind. And they may not care about the returns. Okay. They might be non-dilutive capital, right? They might not even put it in the form of equity. It's grant monies. And it could be just for a specific thing. Hey, we're doing this screening camp, for 50,000 people, in India at the end of the year, and we need, $200,000 to do it. And those are actually, I find, really, really helpful, especially for companies in the earlier stages. One, because it's non-dilutive, right? As you guys have learned, like the earlier in your journey, the more capital you take earlier in your journey, the more dilutive it is because of the valuation. And so if you can front end load as much of your capital raising with non-dilutive capital like this, that's actually a pretty big deal. Plus, the companies at the earlier stages are also a lot more capital efficient. So $200,000 goes a long way, right, for an early stage company versus, some late stage company that's burning $4 million a month. And so it's kind of a win-win, right? So if you think about some corporate foundation, J&J Impact or something, they give you $250,000, you're going to do a lot with that, right? You could do a whole project, you could write something up, you could give them a report back. Like there'll be something very tangible that you can do with that. And that's what they want. And it benefits the company because now you've advanced with more patients, more data, more experience, what have you. And so I think that is another category of what I would call impact capital that I think is really, really valuable, that until I became an impact investor, I think it's kind of untapped. Because if you zoom way out, all of healthcare is kind of impact by definition. Okay. So whatever it is that you guys are all working on, there's a good chance that there's some foundation out there. There's some non-dilutive source of capital out there that's probably going to care about whatever healthcare technology you're working on. Okay. So you don't have to be going to Africa or, specifically addressing an underserved market. I mean, there's a good chance that interesting healthcare innovation is going to hit a chord with somebody. And those investors, they may be smaller checks, okay, hundreds of thousands of dollars. And their process could be simpler. It's typically not an exhaustive due diligence like, a venture investor. There's not a prolonged negotiating process because they're not going back and forth on rights and remedies and liquidation preferences and board seats and, all these terms. It's a little, can be a little bit more straightforward. And they're always going to be a part of your story, right? So they can help maybe open another door or something. And especially if you get a notable name in terms of a strategic or a big provider, a hospital system or something like that, that's actually a great way to get like a Kaiser Permanente on your, your company cap table, if you will, without having to go and get them to be a commercial partner or to go to their ventures group, right? You can still get, I think, a lot of really, really good companies involved with you through that channel. So that's kind of a second type. And then I think there's a third type, which is the DFIs, the development finance institutions, or the governments. And so a lot of governments have their version of it. In the US, there's USAID, there's DFC, there's OPEC. On the spectrum of DFIs, I think the US is a little bit more nascent. So they're still, I think, they're a little earlier on the learning curve. A lot of the European groups are a lot further along. They've done it a lot more. They've done fund investments. Then they've also done a lot of direct investments in companies. And then they'll also do things like debt. Okay. And because they are more focused on economic growth and impact and global health objectives, they also have more flexibility to structure the capital that they provide in a way where you might get, a couple $1 million in debt. There'll be no interest payments. The balloon payment at the end might have a certain, reduction associated with it based on what impact you can demonstrate. Okay. There's going to be more flexibility for them if you get to the end of the line and you maybe can't pay, for them to extend it, because they're not looking to maximize their returns. They're not IRR focused. Okay. Their definitions of success are more about building ecosystem and supporting companies and being catalytic for growth. Okay. And so those groups, I think, are also very interesting for you guys to look at. Takes a little bit longer. They're government. So, just whatever process you're used to, multiply it by 2. But they also can write bigger checks, and they can stay with you for multiple points in your journey. And if you get one, it's easier to get another. And if you get 2, it's much easier to get the third, right? So, so that's also another category that I think is really, really interesting to keep in mind, are these, development finance institutions. And there's probably about, 30 of them that I think are very active. And so I think those groups are also good ones. Now they'll do the same thing in terms of impact and tracking and monitoring, but I want to make sure those are also on your radar. So impact venture groups, foundations and strategics that have, global health initiatives. And then the third would be these development finance institutions.
Great. Yousuf, do you want to share any more on that, or can we jump to questions?
Yeah, we can jump to questions, but maybe just before that, you had asked kind of just about the tips. The one tip I mentioned was, making sure you have the data, which I think is important. The other tip that I'll say is that a lot of these groups, the winds will change. Okay. So, today there may be a focus on, cervical cancer for a particular group. And you call them up and they're like, oh, you're doing that kind of cancer? Yeah, we're not interested in that kind of cancer. We're only interested in this kind of cancer. But next year it could be completely different. Okay. So unlike a venture group where, they have kind of a theme or, an investment philosophy, which could be, for the entire life of the fund, these other groups, these foundations, these strategic, these DFIs, they're changing every year. So the best thing to do is to find a handful of good ones and just build relationship, because you never know when it's going to change, it's going to flip. They find some pool of capital and they say, hey, and we've had this happen to us where they'll call us and say, hey, this one group fell through and we've got this pool of capital that's already been approved by the government, so we need to use it. Do you have a company that would fit this? Right. And so things like that happen. So I think it's really important, just as a tip, to just build a relationship, because at some point, one of them might trigger, an interest.
Thanks, Yousuf. I know we have questions online. I'm going to hand over to Krista to ask one of the questions online, and then Nathaniel will come to you.
Yousuf, you can hear me okay, right?
Yeah, I can hear you.
Great. Okay. So this is from you and Kim. Thanks, Dr. Kim. This may be tangential. When do impact investors decide to share their resources with organizations that are already doing venture capital or nonprofit work? And when do they decide to start their own nonprofit or VC? So she gives an example of giving money to the Gates Foundation or another group already active in the area that you would choose to impact versus creating your own group.
Okay, so can you just read the first part of that question again? Because I want to make sure because I didn't understand.
Sure. Yeah, so when do impact investors decide to share their resources with other organizations that are doing either impact work themselves or making investments versus starting their own?
Yeah.
And maybe if I can even just throw in, and I'm sorry if we're mangling your question here, but like Butterfly, Gates, you brought up Butterfly versus Echo News. Gates Foundation is investing in Butterfly among others. Like, how did you decide to carve your own path? I mean, you spoke a little bit to this versus giving money to Gates to have impact through Gates or another organization.
Yeah. So, I mean, and look, Gates is a different animal altogether. So I think I won't use. Yeah. There's only one of those, right? And so I think about other organizations, right? Let me take. I'll use the Philips Foundation. Okay, Philips, well-known healthcare company. They've done a lot of stuff in Africa. Their foundation, at one point, was very interested in doing fund-to-fund investments, because they said, look, we need to expand our footprint. And really what their objective was to create a sustainable model. Because when you just hand out checks, in some ways that's not always sustainable, because you need money that always comes in the front door so that you can give it out the back door. And so they said, if we could invest, then there's some presumption that we will get some capital back, and so then we can recycle it and continue to invest. Well, over a long period of time, they evaluated that type of a strategy, and they said, you know what, we don't like it. It's fraught with too much risk, because when you put money into a venture fund, there's no guarantee. It's not very liquid. It takes 10 plus years to get it out. A lot of the LPs want you to domicile in places that are tax advantageous to them. And so, does that ruin our veneer, right? We're trying to do good in the world, and VCs are setting up these domiciles in places where they're trying to, reduce taxes. We don't like it. That took them a couple of years to figure out. And now they're very active on the direct investing front. So, but now J&J, for example, they've done sort of the opposite. Merck is a good example, right? Where they're pretty successful on the fund to fund side. So they'll invest in groups like us, and, they'll see those monies, and they have the appropriate expectations, but then they also couple it with direct investment as well. So I think there's a way to kind of hedge that strategy, where you do a little bit of yeah, we'll give it to other people to do it, but we can also do some of it ourselves too. And what we get a lot of, right, is we also get a lot of folks that say, look, if we put money in your fund, can you also tell us if you find something interesting? Because we want to look at that. You're kind of a quality filter. You can be an additional source of pipeline. So we also want to do direct investing. And so that's like Merck, for example. They didn't do it through us, but they invested in another fund. And by way of that investment, they ended up investing directly in a company as well. So there are examples where you can kind of have it, in both ways. I don't know, Krista, if that answers the question or if I'm still missing a point there.
We got a thank you from Yuan, so yes. And for those of you who did come to the JP Morgan, you might remember Ken Gustafson. He's the Merck investor. Yousuf, I assume you're also talking about that's doing direct and into other funds.
Yes.
Nathaniel, do you want to ask your question? You might want to stand nearer to the mic.
Oh, yeah. Thank you for your presentation. I was going to ask about how you measure impact, but you've kind of touched on it. The other thing is there always a trade-off between returns and impact? I don't know what your experience has been.
Yeah. So your second one is literally and figuratively the $1 million question. And so let me answer that one first. Okay. It really depends on who you're asking. Okay. So for instance, if you just look generally at the venture capital as an industry, okay, and now these are just my perspectives, okay, other people may have different points of views here, but I've been a VC for 20 years. My perspective on venture capital, especially in healthcare, is that if you can generate an IRR that's in the teens, okay, so somewhere in the high teens of like 15 to 20%, that's a pretty good IRR. Okay. And if you look at it on a multiple of investment or a multiple on cash or cash on cash basis, if you can generate something that's kind of 2x and above, that's pretty good. Okay.
I'm going to stop you there just because the theme of the talk was demystifying impact investments, and I'm not sure everyone online or in person may know some of those terms. So could you just unpack those as you move forward?
Okay. Yeah. No. Thank you for. Yeah. I didn't want to go into something that you guys are like, hey, why are you talking to me about that? So thanks for pausing me there. So one of the ways, with venture capital, right? We are investors, so we take capital from people and then we have to return it. Well, if you think about any investor that wants to give somebody money, they're going to really think about it in terms of the rate of return that they get back relative to their options. Okay. And, in terms of the risk reward curve, the riskier something is, there's an expectation that you're getting higher returns from it. Okay. So if they take money and they put it in their checking account, they're not expecting much in terms of returns because it's very safe, versus when you put it into, the stock market, you kind of want maybe 10% on average, 8 to 10% or something on average. Well, when you put it into venture capital, it's more risky, right? It's less liquid, it's more risky, there's higher failure rate, et cetera. So it should have a higher rate of return. And so that's what I meant by IRR. That just means internal rate of return, or, year over year, what's the expectation of the returns that you'll get. And so the difference between these different sort of categories is called alpha. And so if you're giving me money and I'm returning you 5% a year, but you can go put your money into a 10-year treasury at 5% a year, why would you risk that capital with me? Okay. Unless you're just this, mega large institutional investor and you're diversifying and things like that as an asset allocator. But for a lot of other groups, they want to see that the higher up on the risk curve they go, the better the returns are. So for venture capital, if you're returning somewhere in that like 15 to 25% range, yeah, you're playing, you're playing the sport the right way. You're generating returns that are higher than stock market and bond market returns, which you should be doing. Okay. And so from that perspective, I use that as a benchmark. Okay. So in other words, I would love to be in that zone. That's a benchmark for me. That's what venture capital is. However, to the question that was just asked about impact investing and is there some concession, I think there's a perception that there's concession. And I think the reason that that perception exists is because you don't want to invest in companies that are compromising commercial returns and growth and success for the benefit of just helping people. Okay. And people think that, oh, that's might be what you're doing, right? Oh, you're gonna give the thing away, or you're gonna, have lower margins than you would have otherwise had if you take that same widget and you sell it, in San Francisco rather than selling it over there. And so there's a perception that you're reducing kind of the upside, right, by doing that, which is not true. That's one. I mean, it can be if you're not parking your money in the right places, but that's also true here too. You can invest in bad companies all over the place. But our companies on average have 70%, 60, 70% gross margins. Those are the same gross margin levels that I saw when I was not doing impact investing. Okay. So from my perspective, I look at companies that fit the mold of generating venture capital rates of return. Now, some investors are more concessionary investors, right? Those other categories that I talked about, they will take what's called first loss capital, or they're willing to kind of accept lower rates of return and so forth. And so they may invest in companies that I might not, choose to invest in. And so every impact investor has a little bit of a different, bend to it. But I don't think that impact, by definition, compromises returns. Okay, you absolutely can have both. The only caveat that I'll put in there is again, on this risk reward curve, one could challenge and say, okay, Yousuf, I can put $1 in a US based venture fund and get 15 to 25% IRR. If I'm giving you money and you're going to put it in India or Africa, okay, which is higher risk geographies, there are less precedents for exits, harder pathways to liquidity, I should be expecting even more than what I get from a US venture fund investment, right? And so I think from that perspective, relative to a US peer group, I would say, yeah, that is a challenge. If it's expected that an Africa fund or an India fund is going to return greater than a US or a European fund, that I think that's a hard bar to cross.
More questions on that?
I'd love to hear him define impact.
Oh, Nathaniel's second question was just defining impact. So you can speak to it broadly or specifically how TEAMFund does it.
Yeah. So there are a set of, kind of well-established standards in the market. There's GEARS and IRIS, and, SDGs can be used as kind of markers. We looked at all of those, but what we sort of engineered for ourselves was kind of a more bespoke approach where we said each company is delivering impact in a different way, right? And we want to be able to look at each company uniquely and highlight what it does, through a unique set of KPIs, right? Measurements that we track and that we report on. So if you go to our reports, you'll see that every company is reporting differently. And it's not just, patient lives. It could also be, quality of life, DALY scores, job creation.
Can you define that for people who may be unfamiliar with what a DALY is?
Sure. So all these metrics are ways of kind of looking at, if you help. So I'll just give you an example, right? Let's say there's a family and you cure, a mother. There is a quality of life, okay, that's improved of not just the mom, but potentially the whole family, right? And so there are established indicators for how you measure, these quality of life scores for people that are impacted positively by something that you may do, for a family. So I'll give you an example, like Forest Health, which does ophthalmology. there's not really a high mortality associated with people going blind. Okay. The mortality rate isn't there. A lot of global health organizations, they really care about the mortality rate though, right? Like how much have you impacted the mortality rate? But blindness, imagine, there's a condition called retinopathy of prematurity. Premature babies don't get enough oxygen. If they don't get enough oxygen, their eyes don't develop appropriately. And if you don't identify that and treat it within the first few weeks after they're born, that person is blind for the rest of their life. But it is avoidable and it's treatable. But you have to catch it very, very early on. Okay. That metric doesn't ever trigger a mortality rate, impact. But there's a huge quality of life impact, right, that you don't want to ignore, not just for that child, but for the whole family, right? A financial burden, a quality of life. Now you've got a productive member of society that can contribute and have a job and, all these things that sort of go along with it. So there are a lot of ways, if you peel the onion back, where you want to be able to describe and ideally even create metrics around, the impact that's happening. Everybody loves data and numbers. And so that's why we have kind of that bespoke approach to really peeling back the onion for each company and describing impact, for each company on a case-by-case basis.
Thanks, Yousuf. And as Yousuf said earlier, if you want to know more, as in get a case example, please check out the annual reports because it has so much detail in each company, how they're thinking about progress, and could make the concept of measuring impact a lot more tangible if you have a look at those reports. Yousuf, we are unfortunately already at time, and I know there's still so many questions, but it's just been such a helpful hour in terms of us understanding more about what impact investing is, how to access it, and for people who perhaps haven't seen themselves traditionally as potential recipients of capital from the impact VC world, I think it's made it a lot more accessible, hopefully. So thank you so much for being generous with your time. We really appreciate it. I wish there was more time because I'm sure there's more questions. But hopefully this isn't the last moment for us to interact. And for all of you joining online, thank you again so much for being here. And we hope this was useful. Thank you, Yousuf.
Okay, thanks. Thanks, everyone.